Good evening, ladies and gentlemen, and welcome to yet another Mango Species. And today we will be comping through the Finance Bill 2025 and look deep into the good, the bad, and the ugly aspects of this bill. My name is Joe Maniki, and I will be your host this evening. We have two speakers who are tax practitioners, a lady and a gentleman. I will allow them to introduce themselves, but before we get to that, I will make a few remarks on this Finance Bill 2025, which comes following the heated debate around Finance Act 2023, which was challenged all the way to the Supreme Court, and Finance Bill 2024, which resulted into the Gen Z protests. And what happened? Eventually, the president referred back the bill to the National Assembly with no proposed changes at all. So looking at Finance Bill 2025, this comes with the promises from the government that there won't be any new tax measures that are likely to increase the tax burden to Wanjiku and to the business society. However, when we delve deep into the provision, we always see the devil is always in the details. We will see some provisions that have a potential material financial impact on businesses and the cost of doing business in Kenya. With that, I will allow our speakers to introduce themselves, starting with Anne, then we move to Ernst. And as you introduce yourself, you can tell us whether this bill has met your expectations as a tax practitioner based on what you are expecting. Over to you, Anne.
Thank you so much, Joe, and good evening, everyone. My name is Anne Magondo. I work with Deloitte as a senior tax manager. It's always a pleasure to have conversation around these instruments that are being released from time to shape our tax policy. So to your question, Joe, I would say just not to the expectation, because though we do not have direct tax provisions to say, we've seen a form of indirect taxation where now we find key sectors that really support our economy, that is manufacturing, health, and agriculture, being affected somehow because of the issue of moving some of these supplies from beings related to exempt. So you'll find that at the end of the day, we'll have an impact on our earnings. It still impact us somehow negatively. Those are my few remarks, but I do also appreciate that on overall, we can see that the government is trying a bit to clean up of the acts by ensuring that provisions in the various tax look documents align. So you find a lot of deletions just to make sure that the Tax Procedures Act, the Income Tax Act align similarly to VAT and the TPA. So it's a good thing that they have done to simplify the tax law for ease of understanding and implementation by the taxpayers.
Ernst.
Thank you, Joe, for having me. This bill has brought a lot of improvements in terms of alignment, in terms of cleanups, in terms of improvements, such as the pensions. I think the improvements that were started last year have been made better by the proposals that are found in the current bill. I think that was a very good move. It now ensures that all pensions are tax exempt, and that will be good for people who get old age. Also clarifying that tax invoice for VAT purposes is a tax invoice contained in Tax Procedures Act. I think that's a good alignment to ensure that there is clarity in terms of when collecting documentation as a taxpayer and also in the course of business. Introduction of advanced pricing agreement, I think that was good. In terms of the banks, a lot of tax incentives have been withdrawn, especially in the VAT Act, in the Income Tax Act for huge investments. I think that was not a good move for people who are in the middle of commencing or implementing new projects where the tax exemption certificate won't have been received by 30th of June 2025. I think that is not a good move, given that we need to promote employment in our country. Moving tax incentives is not good for promoting the employment opportunities for Kenyans within Kenya. Kazi Maju is not the only way to promote employment as a country. We also need to ensure that people stay. Sometimes when we export people, we lose some people permanently, some may never come back. I think that is one of the things that really needs to be relooked.
We get into the specifics of the changes in the bill, and to get us started is Anne. Anne will take us through the income tax changes, starting with pay as you earn related changes or changes that affect payroll. Then we will pause and maybe take one or two questions affecting people who are in the employment sector. And then we will proceed to income tax changes on the corporate. So over to you, Anne.
Let me follow your order, though my thought process was organized otherwise, but it's okay. So I'll move into changes that affect income tax. And we see one positive proposal to increase the per diem from Kenya shillings 2,000 per day 10,000. Of course, this was long overdue, noting that the cost of living definitely has gone up over the years. The 2,000 has been there since time immemorial, and there's been a lot of lobby that this needs to be increased. So having 10,000 as a per diem per day is easy because now employees will not need to carry so many invoices to support anything above 2,000 in respect of an assignment that we're doing out of their normal station where they work from. So that's a good move, and it's really something that is worth celebrating as employers and also as employees. Then moving to the next item that we find coming into the bill, more over cleanup and also alignment, is the issue that employers should grant leaves and exemption on their payroll. So what you find is that of late there has been rise in the tax refunds by the employees, maybe because their payroll was not very well operated, and when it is investigated, you find mainly such refunds arise from reliefs that were not claimed or deductions that were not claimed through the payroll. So these are a good way to ensure the employees do not have to pay extra coin. Of course, as per the law, you should not pay extra coin, a lesser coin in that respect. So it is a good move, but of course, some work on the part of the employer to ensure that their payroll system is up to the task in terms of making sure all employment benefits are given to the employees at the point of doing the monthly payroll. The other item also is more on alignment, the issue of exemption of contribution to Social Health Insurance Fund. What was in the Act, that is the Income Tax Act, was still referring the defunct National Health Insurance Fund, what we used to call NHIF. Looks just a cleanup exercise by the bill. Then there's also the issue of payment of gratuity. So previously, I've received gratuity from a public pension or public entity, then that would be deemed to have been exempt. So that was a bit discriminating on part of the private employees who get from private schemes. So now there's an alignment that any payment of gratuity will be exempt, as well as other allowances paid under a public pension scheme. So we are hoping that as the bill goes out for public participation, there'll be an amendment to make sure that also that other allowances that are paid or also covers or captures those that are paid from both public and private schemes. The other item to note is just also to align the act and make sure that there is no confusion or ambiguity is the issue of benefits that accrue to the employee in form of fringe benefit and also interest that is earned by individuals. We do know very well that interest earned by individuals is deemed qualifying, and therefore withholding tax deducted at source should be fine. So what the bill proposes to do is to ensure and to clarify or to make it very clear that the individual tax rate, the graduated tax bracket, are not applied as regards benefits that are in form of fringe benefit or qualifying interest, because again, the tax on fringe benefits is payable by the employer. On the issue of withdrawal of funds from pensions, there was a provision within the law that would be allowed to withdraw your pension, but then you'd have lesser exemptions. You could be allowed up to 600,000 if you've worked for 10 years and the like. So this now seems to encourage people only withdraw their pension at the age of retirement, or when it is necessary, especially on the ground of ill health. So it's a good move to ensure that people do not rush to withdraw their money, maybe when they change employers. Then when they get to the sunset years, they have nothing to sustain their day-to-day needs. So it's also a good move, a bit of discipline on part of the employees in terms of not allowing for those deductions. Then the next item is on issues of exemption that were being granted to foreign employees or employees who are working for regional offices. Under the current law, such employees would get a deduction of a third of their salary as a deduction if they are just in Kenya to perform a work for an office that is regional. This repeal is just to align and to make sure that we are following the same principle around taxation of employees. It is either based on residency or on the source. Those are the key tax changes that are affecting employees.
Thank you, Anne, for that elaborate summary on the income tax changes affecting people in the formal job market sector. And one question on top of my mind is with regard to payments by an employer from pension schemes. You can clarify to us whether this covers both private and public registered pension schemes.
If I got you right, Joy, you're referring to the payment of gratuity? Yes. So what we have this as the law is only covers public pension schemes. So the proposal is to have both public and private pension scheme included in the exemption. What is missing in terms of alignment is now other allowances under the scheme. So what is exempt is only for public pension scheme, and we look to having maybe that aligned before the bill is enacted to an act of parliament.
Then on the pension schemes, you mentioned that currently the Income Tax Act allows a member of a pension scheme to withdraw tax-free up to 600,000 Kenya shillings from their registered pension scheme, that is before their retirement age. So if I got you right, you mean that in this bill, that proposal to exempt the first 600,000 lump sum withdrawal will now be deleted in the Income Tax Act, meaning that if today I decide to retire prior to my retirement age, I will be taxed on my entire withdrawals from the scheme. And
that is what I would also read in this bill to mean that if you go ahead to withdraw before your retirement age, definitely, then you'll suffer tax without any amount being exempted when you're being paid by the respective pension scheme.
so if I get you right, Anne, is that the big discussion around exemptions on gratuities and the pensions, rightly only people who have attained a retirement age stand to benefit from this provision, right?
And it's on all the draws now, you get full exemption.
Thank you, Anne, for that. I think we can park the changes on income tax for employees at that. And at this point, I would want you to break down the income tax changes affecting corporations or the business world.
The introduction of added percent claim of up to expense in relation to small implements and utensil and similar items, what we call diminution allowance. So this item was somehow not completed. The Finance Act 2023, there was an intention to have it back because we go back to the bill that was discussed. There was that provision. Then again, during the Finance Bill 2024, it was also there to allow for 100%. But since the Finance Act 2024 never went through, the only other chance that we could have it is at this point. So this is a good move. If you recall, the rate at which taxpayers would claim this deduction was at that 3.3%. So that is one of the proposed changes. The other issue is in terms of donations that are allowable for tax. So we've seen an expansion of these in terms of including donations that are made towards construction of public sporting facility. Previously, for such sponsorship or donation, sponsor ought to have received an approval by the cabinet secretary in charge of sports. But now, going forward, if one is able to show evidence that the donation was towards supporting construction of a sport facility, then they'll get that as deduction for income tax purposes. The other big one, and which is, of course, bringing a lot of problems around, is the issue of tax credit for carry forward of tax losses. For some time, we've had this being that you can carry forward your loss indefinitely. You remember the attempt to introduce minimum tax. The government then decided that losses can be carried forward indefinitely, but we do all know that minimum tax was declared unconstitutional, and therefore the government is trying to reverse the position back to where we were. Now you can only carry forward losses for a period of 5 years. Actually, it's more strict here because what we had before was that you could carry forward losses for 10 years, but still there was an avenue to apply for extension. proposal that we have only has 5 years without a provision for extension by the commissioner. We find this is not very competitive and also might impact key sectors of this economy, especially taxpayers who are capital intensive. They have to really do a lot of cash outlay at the beginning of their operations, and before they break even, might take more than 5 years. So they might lose their losses, though they are looking towards generating profit when they break even. So we find this is not very competitive, because even looking across in the East, you'll find this is very punitive. Because if you can check, like in Rwanda, the time limit is 5 years, but also you can be allowed to apply for extension to their commissioner. Moving to Uganda, then they have 7 years to carry forward losses. And if 7 years lapses, you've not exhausted all your losses, then you only lose 50% of what was not claimed. So that is a better move. So you'll only not lose as a big chunk as a Kenyan who invest here, and for Tanzania, which could be more preferable, where if you're in tax losses for 2 years consecutively, then you are exposed to pay minimum tax in Tanzania at 0.5% of your sales. And then if you proceed to still have losses, in the 5th year, if you still have losses, then they'll allow you to only claim losses to the extent of 60% of your taxable income, meaning that you pay taxes on the 40% of the balance of taxable income, but then you're only allowed to claim 60. So they give you options. And I think that facing is in line with the business cycles, because as we all know, when you begin a business, you might have challenges of generating enough revenue to cover your the establishment cost and the outlay. We hope that this will be revised and be more aligned to make sure that we do not lose on foreign direct investment. The other small change in the income tax application for change of accounting year, often you may find that the reporting year of a company changes. Maybe from a group perspective, they decide that you're going to change our reporting year from maybe March to June. So again, for tax, you're allowed to request for alignment with the accounting period. It is in the law that the commissioner should be able to respond within 6 months, but there was no like capping a limit. But now the proposal is that if the commission does not get back within 6 months, then the application will be deemed to have been allowed. The other item of interest to note is in terms of issuance of tax exemption certificate, especially for public benefit organizations that are out here to augment the supply of public services. As the law is today, the commission is supposed to issue the certificate within 60 days after all required documents and qualifications are met. This should be extended to 90 days. Mid last year, the cabinet secretary did release new rules to govern issuance of certificates. Therefore, I think given that the new rules requires an intensive study by the KRA and also production of a lot of documentation to support the object and the work that the said public benefit organization want to pursue, maybe then to just give the commission a good time to make a justifiable decision on the application. Moving on, the other issue is around penalty for the payment of installment taxes. This one has stuck for so long within the Income Tax Act, and it was not aligned to the Tax Procedures Act. The rate in the Income Tax Act is at 20%, but the bill proposes to delete this, which is so much welcome. So for such underpayment of installment taxes, then we expect that the lower rate of 5% would be applied going forward. Then the other issue that has come through for corporates is in terms of payment of tax on what you call untaxed profit, if such profits are distributed as dividends. For those who might remember, a while ago, we had compensating tax, but provisions around compensating tax were deleted and they introduced payment of tax on profits that were not taxed. But then these have been distributed to dividend. Mainly, an entity would have untaxed profits where the accounting profit, that is profit before tax, is in positive. But when the tax computation is done, we end up into a tax loss position, mainly because of maybe incentives or high expenses at the beginning of the operations. But the directors will choose to distribute dividends based on the accounting profit. In such a scenario, then, we find such an entity, if the dividends are distributed, we will be distributing in dividends from income that has not been taxed, because at the end of the day, the entity had a tax loss. Then we have another proposal that is raising eyebrows, that may be the right move, the repeal of the 100% investment deduction for investments that are made outside Nairobi and Mombasa County, and especially in relation to manufacturing and hotel buildings. So there was a preferential rate of 100%, but this now is supposed to be deleted, meaning that all investors, irrespective of where you're investing, as a manufacturer or in the hotel industry, as well as investment by entities in the special economic zone, will be aligned with the standard rates of 50% in the first year, then 25% in the subsequent years. So this might roll back the gains that we'd seen some investors going to discuss with counties, where they would establish plants and creating jobs in the counties. So that may affect the growth of the counties, may encourage also rural urban migration, and also the economic growth of the satellite counties might not be at par because of this repeal. So moving quickly to the next item, I look at preferential tax rates. So we had a preferential income tax rate for entities that were constructing at least 100 units per year. Those are residential houses, and also for those businesses that are engaged in assembly of motor vehicles. Both were enjoying a preferential rate of 15%. This is to be repealed if the bill passes as is, meaning that then this will also pay taxes at 30%. But as we speak of repeal, then you find also the ease introduction of preferential tax rates, especially for entities that are certified under the Nairobi International Financial Center. So for such entities that are registered, then they'll enjoy a reduced tax rate of 15% in the past 10 years, and then 20% in the subsequent 10 years. So they'll only pay the standard rate of 30% after 20 years. The conditions to this, the company must at least invest 3 billion shillings in Kenya in the first 3 years of the operation. Then it is required that such a company also employs the top management. 75% management should be citizen of Kenya. Again, now also startups that are registered still under NIFCA also will enjoy a preferential rate of 15% for the first 3 years, and then 20% in the next 4 years. So those are new entrants into the preferential tax bracket.
We can pause at that and look at what we've already shared. And I will throw a few thought-provoking questions to your end. And the first one is on tax losses. If I got you right, currently the law allows a business to carry forward tax losses indefinitely, right? Even if a business will be in losses for 50, 60, 70, 100 years, they will still be entitled to carry forward the losses. Now, with the new proposal, this limits it to only 5 years. You can let us know whether there's room to apply for extension, and just shed a light on the best practice across our neighbors on treatment of tax losses.
We do not have room for extension as per the bill. So we do expect that this will be lobbied for and included before the bill becomes an act of parliament. I did say that this will have adverse effect, especially for entities that are capital intensive, or they require to incur in a lot of expenses before they can break even. So this might not be a very good move, and it will also reduce our competitiveness as a country, because looking at Tanzania, which also is becoming a hub for investors, they have a better regime in terms of how you utilize this tax loss. For Tanzania, what I know is that you're allowed to carry forward your tax loss, but with some condition. If you run into tax loss for 2 consecutive years, then you'll be required to pay minimum tax at 0.5% of your sales. Then you still continue carrying your losses until the 5th year. So in your 5th year, assume you now have some taxable income, then you'll only be allowed to claim 60% of the profit against the loss that you've carried forward, meaning that 40% of your taxable income will be subject to tax. So you'll pay some revenue to the government of Tanzania. By Uganda counterpart, for them is 7 years. So if you have a tax loss, you can carry it forward for 7 years. If you pass the 7-year limit, you would be allowed to only claim 50% of the balance. So you do not lose everything at a go. And Rwanda, they do have similar 5 years. but then the commissioner can allow you to continue enjoying the deduction if you're able to provide evidence of reasons what made you not to have exhausted the tax loss by the 5th year. As you said, Joe, this is a very contentious issue. It's going to have a huge implication for our country because this is time we would see more investment coming through. But with such a reversal of a key provision, then you find the key stakeholders or key investors may want to look into other countries for investment. So I hope that is comprehensive.
Yes, that was spot on, and I believe it was equally clear to our audience. My next question, or rather clarification, is on installment taxes. Currently, business is required to pay installments, 4 installments across the year on the 4th, 6th, the 9th, and the 12th month of the following year. Right. Now, when you look at it, from the start of the year, and like we experienced this year in Nairobi, or rather in Kenya, business activity was rather low in the first quarter of the year. So looking at the current provisions of the law, am I allowed not to pay the first installment tax and maybe look at the actual realizations in terms of business performance and then evaluate the performance in the second, third, and fourth quarter? If I'm making a realizable profit, I pay installments then. When you talk about the penalty that this bill is doing away with, is it a penalty based on every installment, or is it a penalty based on the total installments paid at the end of the year compared to the pay? You can start at that.
I would say it's good that we are doing away with the penalty of 20% because it was not aligned with similar penalties under the Tax Procedures Act. You well know under the Tax Procedures Act, penalty for late payment is 5%. But for installment tax, it has been 20 for a long time and it's housed within the Income Tax Act. So to your question around whether a company is allowed to pay taxes, rather you can miss to pay an installment tax and maybe already your position in the subsequent period, the law is very clear that you can pay your installment tax on 2 bases, the current year basis, where you'll be required to provide or to do estimates of your projected performance in the year. The other basis is prior year tax liability. There's an assumed growth of 10%. So whichever basis gives you a low amount, that is what you should pay. So yes, you would resort maybe in one instance to having not to pay installment tax in case your projection results into a loss. The only challenge we have, rather, if you look at the law, the way it is designed, is that the commissioner assumes you'll grow by 10%. But where you are, you say, I cannot grow by 10%. Actually, I'll have less profit by the end of the year than the year we are looking at. So for that basis, then you'll use the current year basis. But if in the end result, especially when now you're doing your very final tax computation, it then results that the tax payable is actually more than 10% of your previous year, then you'll be deemed to have defaulted or rather not complied with the law because you're only expected to maybe do your current year basis if you're very sure your growth will be less than 10%. So let me give you an example. Assuming this year you're paying 10 million tax liability. So for the year 2025, you'll under the 10% assumed growth, then you should pay a total of 11 million as your installment taxes. But you go ahead and say this year, likely that by the end of the year, my total taxable income will be 7 million. So over the period, as you continue estimating, you end up with a 7 million. So if you end up at a 7 million, then there should be no penalties because you're below the 10%. But assume now you end up with a payment of 12 million. So this is now even above the 10% assumed growth. So you'll be seen to have underpaid with 1 million. It's a bit of complex, but that is what the law provides. And for some of the taxpayers, and from a few cases that I've seen, iTax has somehow been configured to detect instances of underpayment of installment taxes. And then you find in your ledger there's a penalty imposed. So it's always good to check your ledger and maybe just go back to your calculation and confirm whatever is in the iTax is correct, or there could be an error. So our call is that we all check our iTax pages to confirm that there are no hidden penalties that are based on underpayment of installment taxes.
Thank you, Anne. I propose that we park any income tax changes that you may not have covered at this point. Then we move on to Ernst. And Ernst bring us the tax procedures changes that have been proposed in this bill. We will look at any other income tax changes towards the end, so that we do not make a conversation too monotonous for our listeners. Over to you, Ernst. You can introduce to us some of the Tax Procedures Act changes that have been proposed in the bill.
Tax Procedures Act has not so many amendments this time around. The first one is on e-teams. So the exemptions, provisions under the e-teams have been redrafted just to make it clear. So the original drafting of the exemptions or the exclusions of items under e-teams was not so clear, but it has now been reworded just to make it easier to understand. The most significant that I noted was presently it excludes payment of withholding tax and similar payments. That has been amended to say payments where withholding tax is final. So that is very clear. So if you're dealing with dividend, for example, presently it just says payments of withholding tax. So it is the tax on the dividends, not the dividend itself. So that brings clarity into the application of that provision. Now, when the commissioner gives you an assessment, we will be required to give you the reasons for that assessment. This, unfortunately, only applies to amended assessments, that is under Section 31 of the Tax Procedures Act. However, a similar provision has not been made under assessments under Section 29, which we call default assessments. So we hope in the public participation process that this amendment will be inserted just to harmonize the default assessment provisions and the amended assessments provisions. So at least now when the commissioner gives you the reasons, then you're able to better understand and respond through the assessment. However, another thing that I found that was missing also is any workings. So sometimes you find the assessment is given to you in a PDF format, but the workings therein are in tables that you cannot understand where that information came from. So it will be important that the commissioner also be required to provide any workings that he has come up with to support his assessment so that you, the taxpayer, then can be able to understand. And if you're objecting to that assessment, then you have a clear basis for making that objection. You just find sometimes they omit to send you the Excel, or it takes even a whole week. Yet, once you receive the assessment, the clock starts ticking. You have 30 working days within which to do an objection. But if he has not given you the workings, that can eat into your 30 days. A new provision has been proposed to say that you will not be required to pay withholding tax if at the point that it's noted that the withholding tax was not paid, the beneficiary of that withholding tax has already accounted for the tax. So this is a good move in that it will take away the need for you paying the tax again, which in reality leads to double taxation. You paying that tax, the recipient pays the same tax, and then the commissioner receives those funds twice. And then usually what happens is withholding tax is paid based on a certain year. If you file the returns on that particular year, then this new withholding tax that someone has been made to pay, you cannot utilize it in the next year directly until you apply for a refund or an offset. So I think this will enable us to ensure that no double payments, no going into refund and offset processes, which can be laborious. Sometimes people, if the amounts are not so big, then they opt to just leave it alone, which is a loss. We end up writing up amounts that are deemed not beneficial to apply for a refund. Yet in the long run, such amounts add up to become a lot of money. So I think that was a welcome move. The Tax Procedures Act now will include exemption of stamp duty where the commissioner registers any securities or sells any properties that to collect any tax outstanding. This is being moved from the Income Tax Act into the Tax Procedures Act. So you find that the exemptions for stamp duty were not in the VAT Act or the Excise Duty Act. So now that you have it seated in the Tax Procedures Act, that means it will apply not only just to the Income Tax Act as it is today, it will also apply to the Excise Duty Act and the VAT Act. Now, the commissioner will have power to also do agency notices against any non-resident who is required to pay taxes. So this will ordinarily apply to things like digital services tax, taxes on Bitcoins, where the platform is outside Kenya, any excise duty for non-residents supplying accessible services into Kenya. So an agency notice can be placed against or on an unresident person so that they can collect any taxes outstanding. I was going through the VAT Act and I realized there is not a terminology or definition of the term non-resident in the VAT Act. So I think applying this in the VAT Act will be problematic. In the Excise Duty Act, they've introduced the term non-resident. In the Income Tax Act, the term non-resident has always been there since forever. So I think it's also important that they harmonize this terminology in the Excise Duty Act, in the VAT Act, so that we know who a non-resident is for purposes of VAT. So the bill also proposes to include appointments of the digital service tax agent. In terms of refunds, they want to extend the time period for applying for refunds for the commissioner to look at refunds from 90 days to 120 days. So this will give them time to review sometimes a lot of documents that may be supplied to the commissioner during a refund application. I think that is a good move because sometimes people end up moving into litigations very quickly because the 90 days have elapsed. But I hope now that we are moving to all invoices being raised on e-Teams, the issue of refunds will significantly go down. Wait and see with the auto population. Hopefully that will reduce the needs for laborious audits for refunds by the commissioner. But we wait and see. Objections, they want to reduce the time for filing objections and filing appeals to take it from 30 working days back to what it was to 30 calendar days or 60 calendar days. I don't think this will be a good move, given that December holidays can be a very tricky period. When offices close on the 10th of December and resume 1 month later, say first or second week of January, you find that an objection was received in the middle of December, nobody saw it, or nobody was available to respond to it, and your 30 days have elapsed or are nearly elapsing. And the commissioner may say that closing your office may not have been a good reason. So I think this will not be good to take us back to these days when calendar days applied. The commissioner now cannot refuse to give a private ruling or an account of a previous ruling has been given or a public ruling had been given. So sometimes the commissioner does refuse to give such rulings. And sometimes your application may be more nuanced than what is already in an existing ruling. So I think this is a good move. Then the other issue is on data protection. So the commissioner wants to be able to see anything that you hold as a company, whether it is personal information, trade secrets, and any other private information or any information you consider private. I heard the minister saying that provision was a duplicate because the Tax Procedures Act requires the commissioner to observe the Data Protection Act. However, this provision was meant to emphasize what is already in the Data Protection Act. So repealing it, sometimes when you give out information, you may hope that it will be used for the intended purpose, but sometimes it may not. So I think that may be a slightly retrogressive move, and during public participation, this should be vehemently opposed.
Thank you, Ank, for that elaborate clarification on the TPA changes. For our listeners, TPA is the Tax Procedures Act, and it mainly covers the tax administrative aspects of all the domestic tax laws. That is, administrative aspects of the Income Tax Act, VAT Act, and the Excise Duty Act. Two questions for you, answer, starting with the aspects of refunds. Say the proposed change to give a refund decision from 90 to proposed to 120 days is a good move. Maybe you can elaborate to us how this is good from the taxpayers. It appears it's intended to make the refund application process longer, holding the taxpayers' working capital for longer period, requiring them to incur interest of loan that will be taken up to cover up for the deficit. And
So currently, the refund process requires the commissioner to ascertain a refund within 90 days. Given that department sometimes can be inundated by refund applications, what happens when 90 days end? Then the commissioner has not made a decision. So under Section 47, then where the commissioner has not made a decision, then you have to take it to the tax appeal tribunal because a refund decision is an appealable decision. So you take it to the tribunal. That will lengthen the process even further. So if the commissioner has been given 120 days, then he has ample time to consider that application and give you a decision. You'll find sometimes, especially for any expenses that relate to a period where they're not in e-teams, then determining the authenticity of certain documents may take long, determining whether the supplier has made the supply, that will take long. Remember the issue of missing trader comes in. So someone has claimed inputs, the other person has not declared outputs. So all these things used to complicate things a lot. So I think giving them an extra 1 month, in my view, is a good move. In the scheme of things, in terms of working capital, 120 days, 90 days, that's even within the bounds of how big corporates take to pay or settle any debts outstanding to smaller businesses or SMEs. I don't see that as being unreasonable.
thanks, Hans, for that clarification. At this point, we will change gears back to Anne Magondu. And I know, Anne, you have not exhausted all the income tax changes, but I think you will still pack it at that, address it at the end. So you will come in and give us a glimpse of the VAT related changes. But before that, there's one question from the audience on a fringe benefit tax. Maybe you can elaborate to us what really the change is. I assume currently, once the fringe benefit is computed, then you tax at the normal rate of 30%. You can elaborate clearly what really is the change in this bill when it says the tax applicable rate will be the corporate rate. So elaborate to the audience whether there is any tangible or change that will affect their fringe benefit. And then you move on to the VAT changes. And
basically what happened in December through the tax reform section within the Income Tax Act, we used to call it Section 34, which provided for tax rates. And that is where you'd find the guidance around the tax rate for which benefit tax. So when this act was enforced, then there arose a gap in terms of what is this rate, because now we do not have a Section 34. And then under the schedule that provides for it, that is under that schedule, then we find it was only fair now at this point in time, it is reinstated. So it's purely a reinstatement of fringe benefit tax rate, having been erroneously deleted through the Tax Laws Amendment Act. So it's just, as we said earlier, there was a lot of cleanup of this act and the alignment, make sure that there's flow and there are no obvious gaps that would create confusion and ambiguity for the taxpayer. So the basis of computing fringe benefit still remains. The rate is still 30%. It's only that they needed to make sure the law is clear to that effect. Having said that, and also bearing in mind there are so many changes also, I will move to VAT. So I'll start with items which were previously zero rated and now they have been moved to the exempt status. We have the raw materials that are purchased by pharmaceutical manufacturers in Kenya. So previously, the suppliers of such would claim input tax because this was zero rated, but they have been now proposed to exempt this. So of course, with exemption, there's no room for claiming of refund from the KRA. Then another item that has moved to the exemption, VAT bracket is the input and raw materials that were purchased to manufacture animal feeds. Again, then the other item is the issue of transportation of sugarcane from farms to milling factories. This was related now as per the proposed bill. This will be exempt. We have issues of supply of electric bicycles and also electric buses. So we are reversing our action around green economy and clean energy. Then moving up, we have few items now that were previously exempt, but now they'll be standard rated, meaning now they'll be subject to VAT at 16%. Key among them is the weighing machinery that is purchased by registered hospitals, either locally or that are imported. So these were previously exempt, but as per the bill, then those will be standard rated. They'll be taxed at 60%. Then we have other equipments that are specialized to develop solar and wind energy. These items were exempt, but now as per this provision, then the purchase and the importation of the specialized equipment for developing or generation of solar and wind energy will be standard rated. Going again is the issue of supplies of goods to entities or companies that had been given exclusive rights to explore the oil, the mining, prospecting licenses in Kenya, the like of Talo and the like. I think this is a sector that as a country was to turn fortunes, and especially the oil exploration. And that's why it could be given these exemptions. But going by what is out there, it seems the issue of oil might still remain a dream. So it is applying now to these companies that were given exploration prospecting licenses, and the supplies will be standard rated as per the proposal in the bill. Let me just talk about two other issues, though I cannot exhaust. We have the issues of vehicles that were specifically designed and locally manufactured for use to transport tourists. These are also exempt, or they are exempt as per the law, but the bill proposes that this now moves to the standard rate. And then in line also with the income tax amendment for those construction of houses under the affordable housing scheme, the supplies thereon were exempt. But as per this proposal, then this will become standard rated. Hospitals are also affected. Let me go for this one, where previously supplies to construction of and equipping of specialized hospitals with a bed capacity of 50%, such supplies would be exempt. But as per the bill now, this will become standard rated. I know for VAT, in terms of the key impact to the economy and also what it means, because looking at the issue of hospitals, definitely would say we still have a shortage. We require a lot of facilities, given that also the population is growing and also there are many ailments and are coming up. So it's good to have hospitals within reach of the majority of the populace, but such moves now reversing incentives. It might now make even the medical accessing to medical care becoming very expensive for most people. So Joe, maybe I pause at that point. If you have a question, then you see whether we can move now to the other specific amendments to the VAT on other issues than the issue of moving from one tax.
And thank you, Anne, for that elaboration on the changes from exempt to VATable at 16% and zero rated to exempt. I think you can park it as that. You can tackle any other changes on the main VAT Act provisions aside from the schedules, so that at least it's clear. You can just give us a brief summary on any other VAT related changes.
Maybe one that raises eyebrows is around refund of withholding VAT credit. If you have an excess withholding VAT credit, which is withheld by people paying you, previously you could be allowed to use that refund to offset other tax liabilities. But the bill proposes that you only use such a refund to offset similar VAT liabilities. And you're saying in a case where an entity is in perpetual credit, they might never have a chance to claim that excess or refund of withholding VAT. So this one we feel is not well thought out and should be amended before the bill becomes an act of parliament. Then the issue of application for VAT refunds, especially for zero-rated supplies, the law provides for 24 months, but as per the bill, this will be reduced by half from 24 months to 12 months. To some extent, this aligns with the Tax Law Amendment Act, but that gives a short period but we'll see how the players in the affected sectors will give their participation or their views on it before it becomes an act of parliament. Let me just mention the last one on the issue of bad debts. So if you have bad debts and you want to claim VAT relating to these bad debts, previously you would wait for 3 years. Now this will be reduced to 2 years as per the bill the way it is proposed.
We switch to Ernst, who will bring it to a close for us on the next tax sets that have been affected. And so, Ernst, you can give us in a brief summary changes on excise duty and any changes on the Fees and Levies Act.
So we start with the ED Act, Excise Duty Act. The bill proposes to change the definition of digital lender. There has been litigation around who is a digital lender for purposes of the Excise Duty Act. So last year, we introduced an amendment in December through the Tax Laws Amendment Act. Now they're amending that amendment to see that a digital lender is someone who extends credit through electronic medium. However, I feel this amendment probably would have been superfluous, given that the Central Bank Act last year was also amended to include any non-deposit taking lender now is required to register under the central bank. So basically, you have now two provisions under the excise duty that serve almost the same purpose: the digital lender and a financial institution that is registered under the CBK Act. The digital lender is also licensed under the CBK Act. I think there is no need to have two provisions. I think they should just remove that whole definition of the rates of tax. Also, the definition of a digital marketplace, this has now been harmonized with what is in the VAT Act, just to say any person who makes any supplies through the internet and through a platform, so that all acts now read the same. Then, in terms of the tariffs, in line with what is in the VAT Act, they have included that the East African Common Customs Treaty will apply in terms of definition of the tariffs used in the Excise Duty Act. So I think that is a good place to be at, because then there is no confusion as to what any tariff number that is contained in the Excise Duty Act means, because anybody could then have had leeway to use their own interpretation. They've introduced a definition of a term called non-resident suppliers. This was not there before. We've also introduced a similar term in the Tax Procedures Act, but this is now absent in the VAT Act. So when someone is applying for a license for Excise Duty Act, the commissioner now will be required to give feedback within 14 days of receiving all required documentation. Previously, there was no timeline, so someone could sit on your application for time on end. However, I note that the commissioner has not been given a requirement to tell the applicant which documents are missing and the time frame for telling the applicant which documents are missing. I think that will be good to include so that it aligns with good practice and the practice in the Tax Procedures Act, where the commissioner, when he misses a document, he's required to ask you for it, and also gives you time to respond and provide the document. In terms of changes, in terms of rates, a lot of rates have changed. For me, the most notable one was imported eggs, onions, potatoes, potato crisps, potato chips will no longer be subject to excise duty. I think that is a good move. I hope probably the price of such products will go down. The rest are nuanced, and I would not want to go through that. Under the Miscellaneous Fees and Levies Act, so the bill has proposed that refunds will be governed by the Tax Procedures Act. Refunds, ascertainment, repayment of levies will all be under Section 47 of the Tax Procedures Act. So I think that is a good harmonization to ensure that there is clarity. So the rest is just an amendment of rates for various items. Several items, the rates has been lowered. I think that was the main change under the Miscellaneous Levies Act.
And one question on the excise duty for you before we go back to Anne. Previously, excise duty has been labeled to be a sin tax. And historically, we have seen, of course, some areas that always targeted when excise duty changes are introduced. When you look at this year's excise duty changes, would you say it is aligned to the sin tax philosophy, and why? In which ways?
My view is that the Excise Duty Act today is less of a sin tax legislation and more of a protectionist legislation. So when you feel that you have a sector that you want to protect, if you feel there's a sector that you want to nurture, the place to go is excise duty. You cannot increase customs because customs increase happens in Tanzania, in Arusha. You cannot use the Customs Act to increase any rates. You have to go and get concurrent. But under excise duty, you can increase taxes any way you want. If you decide you want to protect eggs farmers, you go and impose an excise duty on eggs. If you feel that the market is now sufficiently developed and now you can invite competition, you remove the rates. If you feel that you've protected long enough and protection has happened and it has created shortages, then you go and vary the rates. So excise duty is more of a protectionist. Of course, it still retains its own character of sin tax, but there are very few sin items, the alcohols and the cigarettes, and probably petroleum products and coal. Most of the others are just protectionist measures. And then for services, it's just services that are exempt from VAT, especially the financial sector, are subjected to excise duty. Have I answered your question?
Yes, Ernst, you have answered, and maybe I have a rider to that. Looking at the Africa Continental Free Trade Area Act that has been in place for a few years back, I think from, is it 2023 or 2022? Would you say is a time that Kenya and indeed other African countries, even our neighbors within EAC, are relooked at these domestic taxes that affect import or cross-border trade, like excise duty, and looked at a way to harmonize them across EAC and the broader Africa region? What are your thoughts around that?
That is correct. In terms of rules of origin, when you have a free trade area that has been put in place and an item meets the rules of origin requirements in terms of percentages and content, then imposing such duties can be a challenge. Many East Africans had raised issues around non-compliance to the protocol. And so you'll find many of the amendments, many provisions under the Excise Duty Act will recognize the rules of origin for the East African community. But you go beyond the East African community, Kenya has so many protocols. The UK government, the European Union, OMESA, the Africa Free Trade Area. So implementation of this then makes it very difficult because then someone has to understand, okay, which country am I bringing my goods from? What does the protocol provide? Is there any tariff or duty exemptions provided in that protocol? So just like we have with the income tax, when you're dealing with double taxation agreements, you, the trader or the business person, has to then be clear which items fall within the Excise Duty Act, what does the specific protocol and the rules of origin provide, and then look for the most appropriate rates. So this gives double work to everyone so that then probably only goods that come from places that are not protected will be subjected to these taxes.
Thank you, Ernst. I know there are many other proposals that we may not have tackled in our conversation this evening, but we will be addressing them on a new basis. If anyone in our audience has any questions. So at this point, I will request Anne and then subsequently Ernst, maybe you can explain to us the next steps in terms of debating this bill, and from your experience, what do you expect in terms of public participation from what we have seen in previous bill?
Yes, basically what we expect is now this bill will go for public participation, where we expect the practitioners, the sector players will present their input for consideration by the parliament through the committee on budgeting. And so, well, we cannot really say with certainty what we expect. Looking at last year, things didn't go as expected because there was a request for change to the then Finance Bill 2024, but almost that was not listened to, and it didn't go so well with part of the population, and that's why the bill was withdrawn before it was sent to an act of parliament. So we just hope that this year things will be different and the views of the various stakeholders be considered to ensure that we'll transition from the bill to an act of parliament. Maybe what I would ask, get affiliated to one of the, maybe an association or organized groups that do prepare proposals and go and present so that your views out there can be incorporated with the rest of the people. And we hope that the exercise will not just be a tick box exercise, but there will be results. So that is what I would say, Joe, in terms of the next step for this bill.
And the challenge to you is to elaborate to us whether in your expectations this bill has met the provisions of the medium-term revenue strategy and the national tax policy, and areas that you expect the decision makers, the policy makers would look into more keenly to ensure that our future money-related bills mirror the MTRS and the national tax policy. Ernst?
The easiest question, is this a money bill? I think, yes, we finally got to a place where the Finance Act meets the definition of a money bill as per the Constitution. It has only tax issues and tax incidental issues. It does not have any other miscellaneous items. In terms of the tax policy, I have a lot of concerns around the implementation of the tax policy. The national tax policy was put in place in 2023. We had expected by this time we had matured enough to comply with the national tax policy. National tax policy says, one, do not change things more frequently than 5 years. You'll find there are some amendments that were made in 2023, 2022, 2021, that we're still in the implementation phase of those amendments. And now the Treasury is proposing to amend again. And some of these are to the negative. With regards to the investment incentives, I think the proposal to repeal several of these incentives is a bad move, ill-advised. First of all, it minimizes the incentives to invest in Kenya because it now crystallizes that Kenya has a very erratic tax policy. Taxes will change at a heartbeat and incentives will be exterminated or extinguished without no more than 2 months' notice. And if you had planned a huge project with the tax incentives in mind, you'd be damned. Now you have to go back to the drawing board and redesign your project in light of the new tax structure. And even after you've redesigned that new project, you don't know what will happen in the future. Tax changes may happen and we don't really care about you, the investor. Probably this may reduce the time to markets for certain investments. Some people will be forced, anyone who has not applied for any exemptions yet, or someone who has a project in the pipeline or is envisioning a project, they have to go back and redo their numbers again to reflect this new reality, which is not good. So we're looking to increase employment. However, we're doing our best to ensure that we don't have employers in Kenya. So for me, that was the saddest point of this bill. The very many negative proposals that if you allow them to stay for another 5 years, you give them a sunset date of say 2035 or at the earliest 2030, then you give people a little time to reorganize, arrange, and also do all the necessary planning in light of the sunset days. In developed countries, such clauses are given sunset dates, proper sunsets, and not just 2 months or 1 year. 1 year for a huge project is an abrupt stoppage.
Thank you, Ernst, for your comments and your lamentations around the bill in terms of affecting the employers, current employers and potential employers that could be looking at setting up in Kenya. And of course, thank you, Anne, for your comments also around the next steps and where our audience can chip in. Obviously, the National Assembly will be publishing a notice to share the timelines within which we can submit our proposals and our memorandums on areas that we need to look at. And obviously, Mwango Capital will be submitting a memorandum on some of the areas that we have touched on today that we think our MPs need to relook at. Ladies and gentlemen, we would not want to belabor the discussions that we have had. I know there are a few that we may not have tackled, especially on areas to do with the transfer pricing, on the advance pricing agreements, which will be effective by 1st of January 2026. Other than that, most of the other proposals, if passed as the year, will be effective from the 1st of July this year, 2025. So that brings us to a close on this year's Finance Bill 2025 basis. Thank you very much for sticking around with us to the very end. And I hope we had an enlightening discussion around the Finance Bill. We hope you will be able to debunk the myth and the propaganda around this bill when you see it doing rounds in the social media. And on that, I wish you a good evening and be on the lookout for more of thought-provoking expresses from Mwango Capital. Thank you and have a good evening.